Fees plus
Yes.
equity.
Yeah. Okay. So if this is clear, we will move on to EBITDA. So what does this mean? First, understand. Let's try to understand earnings before interest, tax, depreciation, and amortization. So, okay. In other terms, what do we call this? It's called OPM,
Huh.
operating.
Spell that. What is EBITDA is equal to OPN. Operating what?
This is operating profit, or you can call it as. So this is earnings before interest, tax, depreciation, and amortization. It is also called operating profit.
You said OPM. What was that?
Operating. Okay. Okay.
That is
Sorry.
margin.
I mean,
So is it clear?
yeah.
Okay. So this, for example, in many big organizations, right, when they have a variable pay attached, it is always linked to the EBITDA that the company generates. Why is it so? Anybody has some thoughts on it?
Can you repeat the question?
So in many organizations, right, the variable pay that is given to their employees depend on the EBITDA, not on the net profit.
The link to the performance of the company, right?
Yes, but net profit also is a performance of the company.
The tax, what is calculated on those variable payment? Company won't be giving tax. The employees will.
Yes, exactly. So that's the point. So for a company, for employees, right, it does not matter where they've got the money, whether it is their own money that they've invested or whether they've borrowed some money and they've invested. They're least bothered. They are involved in operations, and if operations are efficient, then they should be paid more. They are not responsible for the interest that the company has to pay for borrowing money. So this is the fundamentals behind it. And if you can understand, or please ask more questions if you have, but if you can understand this, I think you'll be able to understand what is this debt, what is this leverage, how does that play around, and it will make more sense for you.
I would want you to repeat the last 5-7 minutes again. I'm sorry.
Okay.
From that.
The question that I asked was,
Yeah. Okay, go ahead.
so the question that I asked is, why does an organization, when they pay out variable pays to their employees, right, link them to EBITDA and not to the net profit? EBITDA in the sense operating profit. Why do they link it to operating profit, not on the net profit? So the answer
Because
is,
from the customer perspective, that is their responsibility, no, right? They have to
not em- not for
what
the
do you call
customer,
it?
but I'm speaking
Pay
in
the
terms of employees.
tax.
Employees, I mean.
Yeah.
So the reason is, operations is something which the team does, and it is their concern, and it does not matter to them whether this money that was arranged to run the organization was borrowed from somewhere, or is it something that they invested from their own reserves and surplus. So it is not a matter of interest. A true indicator of performance of the company with respect to their employees is their operating profit or the EBITDA. So more
Correct.
is the.
Because from customers because from owner perspective, that is one,
Yeah.
that is liability or whatever it is, right? So whatever is rest will be given to the employees or whatever the bonus thing is and all, right? After
No,
paying
they
the
could.
taxes and all.
No, that will happen. But the question was, why, for example, net profit has grown by 10%. So my bonus pay will be 10%. That is not how an announcement would be made. If the EBITDA is 15% and net profit is 10%, still employees get 15% bonus, not 10%.
Okay. Okay.
So that is because a
I'm not
tool operations is EBITDA and it is not net profit, because when the difference between EBITDA and net profit is the taxes and interest paid, which is not employees' problem.
correct.
So that's the reason. So where do we find EBITDA or EBIT or operating profit or operating profit margin?
PL.
Yes, correct.
Yes.
So let's quickly go and check. So in here, in the profit and loss statement, we have operating profit here and a ratio of operating profit to this total sales. You see, 152,664 divided by 869,443. So this is fairly roughly around 18%. So that is what you get it as operating profit margin. So did you understand how to calculate operating profit margin?
Yes. Operating profit divided by.
Yes. And why there is a difference between sales and operating profit is the expenses that you expense out. You sold 100 rupees worth of biscuits and you paid 10 rupees to your labor. For the flour and machineries, you spend maybe 50 rupees. So all that is left to you is 40 rupees. 100, labor is 10, machinery, raw materials is 50. So what is left to you is 40. So the operating profit margin is 40 divided by 100, which is 40%. Is this clear? If it is clear, we can move on to the next one.
So by and large, whenever you say margin, it's a ratio.
Margin is always a ratio. It's a percentage basically. Yes.
To interpret.
Sorry, I did not get your question.
Is that percentage always on the basis of sales, the revenue? When we say margin, it's always the denominator is revenue.
Don't go by any of such thumb rules. Try to understand the meaning of each of them. Then you will be able to create by yourself. Don't worry about
that. To understand it crudely, an operating margin of 18% would mean if I if I had a revenue of 100 rupees, I am making 18 rupees as a profit, right?
Correct. But still, you have to pay taxes, you have to account for your depreciations and a lot of things that you have not done yet.
So that comes after EBITDA. EBITDA, yeah. Operating and other was gross.
Yeah, correct. Okay. So net profit is what it is called, or PAT.
So OPM doesn't include the net profit, right? It is based on from the total sales.
Yes, correct. So you are just taking out all the expenses from it. You are not accounting for the interest that you pay, or you are not accounting for the taxes that you pay and depreciations, all of these. Now, this is more a popular term called EBIT. So from EBITDA, if you take out depreciation, you get EBIT. Fairly simple to understand, right? So you take EBITDA or the operating profit, just subtract the depreciation and amortization section, you get EBIT. So where do you find this? Yeah. Okay. So from now on, I think there are a few ratios that we will have to understand. Of course, I think we touched upon this operating profit margin or the EBITDA margin. So this is clear, right? Okay. So where do we find EBIT? Where do we find total sales? Both of them are available for us in profit and loss statement. Clear?
Yeah.
Okay. Next, get into net profit margin. So what is net profit margin? It is basically in this EBITDA, right? You take out DA.
Sorry, EBIT is also called PAT, is it?
No. PAT is this here. PAT is also called
net profit.
So, I think where was I? Okay, this we explained. Okay, so next is net profit margin. So, what is net profit margin? It is basically net profit divided by total sales. So, where do we get net profit? Net profit is P&L. Total sales again in P&L. Is that clear?
Yeah.
Okay. So I think if you go by logic, right? EBITDA, you take out DA, you get EBIT. In that, you take out T and I, you get earnings. That is your net profit. So to simply put, right? So you have your revenue or sales, then you subtract expenses. Then you get, correct? Then you subtract
Depreciation.
interest.
Amortization.
You subtract interest. Then you subtract depreciation, amortization. Then you subtract tax. All you get is PAT. Oh, sorry, I think it's too small. So this is the logic of profit and loss statement. This is also called operating profit. This is called net profit.
Net profit is after giving money to anybody and everybody who is, somehow owed some money, taxes and depreciation or
Correct.
whatever it is. And
Correct.
operating profit is without all those.
So this is, for example, you procure raw materials, so you have to pay your vendor, that is gone, and you have to pay salaries to your employees, that is gone here. Then what you have is left here.
Right.
Then you have borrowed some money, for that you have to pay interest, that is gone here. And you have bought some machineries that is getting depreciated, that is gone here. Then to government you have to pay tax, that goes out here. What remains with you in hand is net profit. This will be borrowed, taken forward to the reserves and surplus for the subsequent year. Okay, switching back.
Sorry, Akash, one question. So your dividends are paid from net profit, right?
Yes, correct.
Company.
From here you pay dividend out.
And then after that, what is left is retained earning. I think that will come.
Correct. Normally, if you don't pay dividend out, whatever is coming out as net profit or PAT, we will add it to the reserves and surplus. But if you pay dividend out, whatever is left is added back to the reserves and surplus.
Okay.
यार ये एग्जाम में सब याद रहेगा, मुझे डर लग रहा है अभी से.
I think this is fairly simple. You don't have to remember anything, but see, this is the crux of profit and loss statement. If you understand this much, I think
Yes.
most of it is got.
Okay, great. Yes, it is in the definition itself, so I think
Yes.
I will remember that much.
Yeah. So next is these three equations, which are very interesting. But I will go to this one first, and then I will come to these.
Sorry,
So-
Akash, sorry to interrupt. Can you repeat again the reserve and surplus and the difference between the return earnings and reserve and surplus?
Yes. Okay. So, for example, let us assume that net profit that we have made is 100 rupees. Okay. So,
Okay.
there are two scenarios. Let's assume case 1, where dividend is 10 rupees. Then retained earnings is 90 rupees.
Correct.
In case 2, if you don't pay dividend outright,
Mm-hmm.
then all the money that is there will be moved to retained earnings.
No, correct. Yeah.
So that's the only difference.
Okay.
Some companies pay out dividend, some don't.
Got it. So the return earnings and the reserve and surplus, that's same, right? I mean,
Yes, correct. So reserves and surplus is a cumulative value. Retained earning is for this year. For example, to last year's cumulative reserves and surplus, you add this year's retained earning and you become updated reserves and surplus.
I see. Okay, that means the beginning return earnings plus the current operating year end of the return earnings.
Yes.
Okay, got it. Thanks.
So reserves and surplus is a sum of retained earnings throughout the life of the organization. Okay. So I think one important thing that I explained here you have to understand is basically return on investment minus cost of cash. Okay, this is basically free cash flow, cost of capital. So this is one thing. I mean, maybe not for exams, but these are crucial for you to understand. So that is why I'm putting it out here. So that is the first one you should understand, and the second one that you should understand is this. So I don't know if professor who is taking classes for you explain this. Something like this. Return on equity.
ROE was it was explained.
Yes.
ROE is fine, but this leverage ratio multiplied by asset turnover ratio multiplied by net profit margin.
Yes.
Okay, so this is a very good way to understand the business. For example, what happens is, why is return on equity important? So this is something that we will have to understand. For example, a business has 100 rupees with it. If it keeps this money in a fixed deposit, they naturally get 5 to 6% as returns, right? Even if they don't do anything. For example, the very purpose of doing their business is to make sure that the return that they are making on their equity is higher than what a fixed deposit or a government bond gives them. So this concept is clear.
I'm not sure. People are saying ROE is LR into ATR into NPM, but what I have noticed is it is net income by total assets.
Okay, ratios I will come. So ratios are here. So I will come to ratios, but I want to bring you to this to your notice that first let us understand what is return on equity. So return on equity basically is a measure of how you are generating returns with the money that you have in your organization. So even if you don't do your business, just keep that money as a fixed deposit, you are by default getting 5 to 6% returns, right?
Mm-hmm.
So you should make something more for a meaningful business. So how do you understand if a company is making meaningful business or not? First thing people check is return on equity. You just check what is the return on equity, then you get a fairer understanding of how the organization is being run. If they're generating mediocre returns, right, it means to say that they're not really doing a good business where you have some lucrative opportunities for you to invest. So what do I mean? So
when you
let's
use mediocre, what is the number we are looking at? Like how much should it be for it to not be mediocre?
So in India, government bonds yield you 7% interest, 7 or 8% interest. So you get this money by doing nothing, or rather, inflation is also eating that much of money, right?
Correct.
So you should make something more to be meaningful. So if you have a look at Reliance Industries, right?
Mm-hmm.
If you have a look at their return on equity, right? In the last 10 years, they have made on an average 10% every year.
Mm-hmm.
Let's take a different example. Maybe somebody wishes to put some names.
It will be different for different organizations, right? So if my savings account is giving me 6%, so the Reliance is giving me 10%, then another company is giving me 15%, another might give me 17%. So
it is not as an investor I'm speaking. So if you go to their balance sheet, right, they have this money, reserves and capital, right? This is the total money they have with them.
Yeah.
Right. So this money, if they don't invest, they don't do business, just keep this money in the bank, they get 5%.
Yes.
If they do business, it should be more meaningful. They should generate more, not just 5%, right?
Correct.
So that measure is shown here. So every year with this money, they were able to grow this money by 10%.
Okay.
It's nothing to do with the investor. Investing is different. I'm not speaking anything about
No, but
investment.
as an organization also, if it's my company, let's say, right? Forget about investing or something, right? If it's my organization and I am getting 5% return on the money that I have at hand, I would like to generate it more and more. However, what is mediocre and what is excellent will depend on the industry I am in the country I am in, how are the government laws. So I'm wondering, like, how do we decide, like, this is okay for me or not?
How do we decide that? Is basically if you are generating anything below government bond yields, right? Or below inflation, then there is no point in running the business at all.
Correct. That's right.
How much more to generate? It's left to you.
Okay. Okay.
So the crux is the money that the company has. How much returns is it generating?
Yeah, it should be used for something productive, and you should be doing all these things to generate a better profit margin over what the government is giving you for free, right? Just by keeping the money. I understand the logic, but I'm trying to understand if there is a range that we look for in an industry or in like, if I'm generating mediocre or if I'm generating excellent returns. So what is the definition of mediocre or excellent is what I'm trying to understand. Of course,
there is no hard and fast rule. You as a business owner can create it for yourself. You can look into your competitor, see how much returns they are generating, and put a bar above or below that. If you're aggressive, put it above. If you're not so aggressive, put it below. It's left to you. But what I'm trying to tell is, if you're not generating even what inflation is eating, right, or your government bond is yielding, there is no point in doing business. Just
100%.
Start the business and put this capital somewhere else, and it automatically generates money.
True. Okay.
So higher this return on equity, better it is for you.
Yes.
So how do you measure this? So the formula goes like this. When I say return on equity, this is PAT divided by total equity. So what are you doing with this PAT? You are moving to reserves and surplus every year, right?
Yeah.
So that reserve, the moment that you are making to reserves and surplus divided by the total equity you had at the beginning of the year, that ratio is simply your return on equity.
Okay. And the higher it is, the better. Yeah.
Yes. So you don't have to mug up this now, I believe. So it's clear, right?
Yes. But don't delete it. Let it be there. We might need to review, right?
No, I'm not taking anything out, but it is clear, right?
Yes.
Please ask me questions if you have. I would be happy to answer. But the way you have to look at ROE is this. Now, let's combine this equation together. For example, somebody sees an opportunity where they want to expand their business, but they don't have so much of equity with them. What do? They surrender to leverage.
So Akash, can I just jump in?
Go ahead. Yeah.
So this profit after tax is made using all of the resources, which include assets also, right? And also debt. So how do I say that this return on equity is only can be? I mean, it's only earned by my equity. It's not just equity who's giving you the profit after tax, right?
No. I think that is the exact point where I was going to. There is something called ROA also, return on
ROA. Mm-hmm. Okay.
So the difference between these two, if you don't have any leverage or you don't have any borrowings, right? Your total assets and total equity matches.
Correct.
In that case, both of them are the same.
Okay.
But if you have a look at Reliance Industries today, their total assets is where is it? So the total assets is this much, but their total equity or reserves and surplus is only this much, which is lesser. So all that they are trying to do is, for example, they are generating 10% on their equity, right? If they find a place where they can borrow money from people at 6% or 8%, in fact, that is what they do when they issue debentures or borrow money from banks, right? They borrow it at 6% or 7%, but they generate 10%. So the remaining is for them to enjoy. So the difference between return on return on assets and return on equity is this. If the company is having no borrowings, then total assets equal to total equity, then ROA is equal to ROE. But if there is a difference, maybe because they have borrowed, right, their return on assets might look big, but their return on equity might look big. But don't get carried away. You should also see what is the return on assets. Hope I made some sense out of it.
If there is a big difference between the two numbers, ROA is less than ROE by a huge difference, that means it's not their own money that they're generating profit on. It's
Correct.
all borrowings and stuff, right?
So ROE cannot be more than, ROE has to be more than ROA. It cannot be less.
Yes.
If ROE is more than ROA, what does that mean is, basically you take the ratio of these two, it's called leverage ratio. If it is more than one, they have some borrowings.
Correct. Correct.
So all that you have to be very careful is, they're generating high return on equity, but that money is not all for the investors to enjoy. It also has a share of the borrowers lenders who have lent money. So if this three is clear, then I will go to this crux of this equation, which is quite interesting. So what does this mean is, so as a business owner, if you want to increase return on equity, right, that is your primary goal. Yes. How do? You do any of these. Either increase if you want derivation for this, I have a derivation I can share, but it is not so interesting. Don't worry too much about it. But you can either increase your leverage, take more money, which is meaningful. So your return on investment should be more than cost of cash. So you take such money and expand your business, then your return on equity will increase. Or you increase your asset turnover ratio. What does this mean is, you run your assets not just for 8 hours, maybe run for 20 hours, for example, somehow. Run in 2 shifts. Okay. Then you will be able to produce more goods and sell more, and your PAT will increase, so your ROE will increase. That is one option. Another option
ATR is asset to? Sorry, ATR is asset to?
Asset turnover ratio. I'll come below. I will explain it here. It's here. But try to just go with the flow. Try to understand what is being told. So if you can increase your leverage, good debt, or you can increase your asset turnover ratio, running your machines more, or you can also increase the net profit margin. How do you do? Maybe increase your MRP of the product, for example, if it still goes. By doing any of these, you will be able to increase your return on equity. So it's a call that you will have to take as a business owner. If you see opportunities to expand your business, then borrow money and do. Or if you see an opportunity where the existing factory can be utilized more, then you run machines for more time and do. Or if you see an opportunity where you can increase the price at which you sell your product, and still you can continue to generate so much of sales, then increase the MRP and do. So as a business owner, you can play around with these three and you can increase your return on equity. And you can do multiple of them also to increase the return on equity. So any questions on this? Okay, I believe no. Then we will move on to the second set of equations. So far this is fairly simple, I believe, but don't end up in a stage where you have to mug up these, but if you have questions, please ask me now, I can explain. But I think if you can understand this, appreciate it, would help. Okay, quick questions, we have to fill this source now. So where is PAT?
PL.
And where is total assets?
Balance sheet.
PL only. Sorry, balance sheet, total assets on the top.
So the next one?
ROE and ROE.
PL and PS.
Oh, ROE also. Okay.
we don't find it anywhere, we have to compute it. So this is also computed.
Yes.
Okay, so we will move on to the next set of ratios. These are also interesting on similar lines. So let's try to understand what is asset to equity ratio. Total assets to total equity. So first source, where do we find these?
Asset to equity ratio, both are in the
Balance sheet.
computed.
Correct, but the source of these two, if you see, total assets and total profit.
Balance sheet.
Balance sheet.
This asset to equity, isn't it LR?
No?
No.
But if I go with the formula, LR is asset by equity, right?
I mean, this is total asset, total assets that you own.
LR is also ROE, ROA, right? PAT get cancelled, the total asset by total equity, right? And that's why that's how I understood it.
Maybe you will get. You can compute. Yeah, it could be it could be like these two are same or reciprocal. So I mean, it should be fine, not an issue. But I think you will also get questions on what is return on equity. Sorry, asset to equity ratio also is something that you will get in exams. So you should know this. And see, this is not a popular term. Okay, this one, put it here. This one, or for example, this one here, this one here. I don't think books teach us this. Okay, so this is more about understanding as an analyst. So these are things that I've put here, right? These are not common terms, but rest of them are common terms.
Okay, what I understood from LR is how much borrow more from the bank, from the institutions rather than from the public, maybe, or from the investors.
Yes, exactly. So how much is it? What is the magnitude of this in comparison with other one? Yes.
Okay.
Okay. So next, let's look into asset turnover ratio. So asset turnover ratio. I mean, first let's identify the source. Basically, it is net sales divided by total assets. So where do we find net sales?
P&L.
Okay. Total assets, balance sheet.
Balance sheet.
Why do we take these ratios, net assets and total assets, net sales and total assets? So it is an indication of how much sales we are able to generate from the factories or machineries that we own.
Okay. Asset turnover ratio. How much sales do we generate on the assets that we have? How much sales do we generate? Okay.
Yes. So, somebody has a question. Sandeep has a question.
No.
Okay, fine. So the next thing is inventory turnover ratio or stock turnover ratio. So here, okay, when we say assets, there are a lot of things involved, right? Factories, machineries, and a lot of them. But if you just want to know how is this performing against inventory that you have, right? Inventory is also an asset for you. But if you want to understand a comparison of inventory turnover ratio, then you can take these ratios. Net sales by total inventory that you possess.
Inventory is what? Whatever I sell, the product, right?
The products that
not
you have.
The raw
no, not the raw materials. The products that you have, which is finished, but it is not sold yet.
Okay. Okay. Got it.
So, why do we measure this? Anybody has some thoughts?
Stock, net sales.
Okay, let's take a scenario where a company has produced a lot of goods. They have made a lot of inventory, but they are not able to sell. The problem is it might get stale. The inventory might get stale. You have to eventually throw them, for example.
So
at least if it is in the form of,
to know the shelf life.
Yeah, correct. I mean, right. But see, even if it's for example, a fabric cloth, right? It will lose its value over a period of time. Maybe it will fade, or maybe it get stolen, or you have to spend money to even maintain it in a warehouse, or maybe it gets out of fashion. There could be a lot of reasons like this.
There could be expiries as well.
Basically, the
Yes.
money
Control the production.
Money sitting on the
Yeah.
shelf, basically. Yeah, right.
I mean,
Yeah.
money. It's not money. If it's in the form of money, maybe total assets would make sense. But here you have already converted them to inventory. It might get
No, the logic of seeing this is how much. Ideally, we should not have much inventory maintained.
exactly.
So
Exactly.
whatever we produce, the idea is that it should be sold.
Yes. Yes.
And how I would see how much I'm producing is how much I'm selling and how much I'm still holding.
Correct.
So basically,
So-
to get the projection, the manufacturing and production. Based on this ratio, they can take call like how much they need to surplus inventory. Based on that, the future manufacturing and production, how they should plan.
Correct. Yeah. I mean, that is true. A good company has a process in place to make sure that they have lesser inventory as less as possible.
But why is this inventory is not in terms of money? Why it's in numbers? I mean, inventory is in terms of money, is it?
Yes. Yes. So you.
Okay. It's not quantity of whatever.
But you cannot. If you cannot sell them, you cannot convert it to cash. It might go stay. The salvage value could be lower.
No, my question was: is inventory in terms of money?
Yes. Yes. It is in terms of.
Yes,
Okay. And that money, I mean, conversion factor is your
price
whatever you're selling it.
price of the product is the money.
COGS. If
How
you
many quantity into price, that will be
COGS,
your,
yeah.
if you know
Okay.
COGS.
But that is sold, right? But
No, even for inventory, okay. Maybe financial accounting as a subject is not still introduced to you, I believe, right? Sorry, management accounting is not taught to you, right?
not yet. We'll have for module 2.
So in that you will understand how raw material is getting converted to inventory, cost of goods sold. How do you account for them is explained there.
we did read about COGS.
Okay. So COGS is basically the cost that you incur to produce your inventory.
Inventory, correct? Yeah. Okay. Yeah, got it. Thanks.
Okay. So it's clear why we measure this number.
Yeah.
So
And
what
it has to be as high as possible. Always. That's
What do we infer when we say it is inventory turnover ratio is 3? For example,
Means I can earn that 3 rupees from this inventory sitting on my shelf.
no. It means that 3 times.
3 times I'm selling. Yeah.
Calculated your money. I mean, in 3 times, right? You converted your cash to inventory, and then inventory to cash to inventory to cash. You made money this way. 3 times you are able to sell them.
Oh, okay.
So higher it is, the better it is for an organization.
Correct. It's called. Is there a name for it? Anything else? Stock by inventory.
Inventory turns.
So Akash, this inventory we are taking from balance sheet, right?
Yeah. That was the next question. So where do we take net sales?
And balance sheet will have and the day we are preparing the balance sheet, on that day, whatever inventory is there.
Yeah, true.
Okay, so how did you, I mean, how does it relate to the statement that you made? Like how many times you, like if it is 3, then 3 times you, so I didn't understand that point.
Okay. So, I mean, in real world, right, these ratios will slightly differ. So you should look at previous inventory, see what is the delta inventory that is getting added this year. So you have to do all this jugaad to finally come at this number. But for simple understanding, you can look at the inventory. You assume that the closing stock of the previous year and this year at any point of time will not vary too much, the inventory levels.
Okay, when you said 3, I just calculated 9 divided by 3. Okay, so 9 rupees is my sale, and 3 rupees worth of inventory is lying on the day when I'm preparing this balance sheet.
Correct.
Okay, but then I didn't understand, that statement. I think there are many other concepts behind it, maybe.
Yes, yes. Inventory is basically previous year. For example, last year closing stock, if you see, you had an inventory of 3, and this year you have made, maybe not at the end, fag end, maybe you have not closed your PNL, but you see that you have made a sale of 9 rupees. So if you actually see, maybe it could be different because this year's balance sheet is not up for you. So you are taking previous one and you have added a guiding number, maybe change it to 4 because of some reason, and then say 9 divided by 4 is your turns.
Okay, so when you made the statement saying the bigger the number is better, right? So, for
Correct.
example, 10 is our sale, and our inventory on the balance sheet day is 2. It's 5 then.
Yes.
If the inventory is bigger, let's say it's 4, then it's 2.5, so it's getting lesser. And it shows that inventory is more than what it should be.
Okay, I will put this question the other way. So if you have your inventory for 100 days, for example,
okay,
you are not getting any money out of it, right? I mean, inventory is just inventory. But if you have it in cash, that 100 you can book on a fixed deposit, and with the same tenure, right, 100 days, you'll get some money out of it.
Correct.
Opportunity cost. So that is why inventory has to be light all the time. So if inventory is lighter, then your inventory turns will go up. So if inventory turns will go up, then it indicates that you are doing your inventory management better.
Understood. Thank you. Yeah.
So quick question on where do we find these net sales?
PL.
Yeah, and inventory? Inventory
is PL on. Sorry,
no.
Assets, right?
Yeah.
Balance sheet.
The balance sheet. Okay, so I think we have run out of time. I think people are inviting me for the next meeting, so I'll quickly rush through for the rest of them. So on similar lines, you had debtor turnover ratio. So this is something that these two I'm not explaining. Maybe you can have, try to go through these two. If you have questions, it's fairly simple. If you know this and this, you'll be able to do this. So let's get into debtor turnover ratio. So what does this debtor turnover ratio mean is how quickly are you collecting your money from your customers. So you make a sale, I will change it to net sale, and then, for example, you receive money next year, 1 year later. Then there is a problem, right? If you get it on day 1, you can put that money in a fixed deposit or do something else with it, you will generate more money. Because you are giving it to your customer, that credit cycle, right? You are not earning anything out of it. So it's a issue that you are facing. So if you measure this ratio, net sales to total receivables, then you will understand how quickly you are receiving your money. The quicker you receive, the better it is.
Okay, makes sense.
So where do we find this? PL and balance sheet. So these two are fairly simple. So in the balance sheet,
asset over current liabilities. Right?
And net
CA is current assets.
Current assets and current liabilities. So I'm also not spending too much of time on this. These are fairly simple. I've marked them in yellow. Please go through, and if there is any question, I'll be happy to answer. If you can summarize it to Jeet, I will maybe respond and tell what it is. You can also reach out to me, for example, on LinkedIn. I can also help you out. So the last one I wanted to mainly focus on is the CAGR. So this looks like a very complicated equation, but trust me, it's not. So let's do a small calculation to understand this. So I have 100 rupees with me this year, which is 2023. And I want to understand. Okay, so let us assume that I am generating an interest of 8%. Okay. Then what happens to this money next year is basically multiplication of this. And then if I keep doing this, right?
Yeah.
So basically at 8% on these many years, I've doubled my money, and the interest is 8%. What if I tell you this 2023 I have 100 rupees. By 2032 I have to make 200 rupees. How much should be my growth rate?
Great. Yeah.
So what you have to do is basically this divided by this, raise it to the power caret.
Compound interest, the formula.
8, 9, 10, and then minus 1. Okay, so did you get this? This divided by this to the power 1 by total number of years that have compounded, and I'll get 1.
Okay.
So the beauty of this is you've got this by, for example, I will make it 1.09. This is 1.2, for example, 20%. This 1.0. So even if you have this variable returns, right, if you want to find an average, this CAGR will help you to find.
Makes sense.
What's the average of this? And CAGR is computed for many things. If you see, right, CAGR for sales, CAGR for profit, CAGR for stock price, CAGR for return on equity. So CAGR mainly in the profit and loss statement, right? CAGR of sales, CAGR of expenses, CAGR of operating profit, CAGR of NPM, CAGR of EPS. So all this you can do.
So these CAGRs are for past, right?
It is for the past, yes. Compounded annual growth rate is the name of it.
Okay, so whatever you have mentioned in row 5, those are the numbers you're showing in percentage.
Yes.
That's the growth rate.
Yes.
And then you're saying, suppose in 2023 it is 100 into 1.08, and that's how you're getting these numbers. So it will compound with respective percentage every year.
Yes, correct. So in other words, right, what I am also trying to tell is, even if you grow in this fashion, it is the same as growing in this fashion of 0.845 every year. Okay, so here if you have 100, then this star
Q16 just raise that, extend that.
got it?
Yeah.
Do we have anything else? How much time are we going to do?
I think I'm fairly done.
Okay,
I think I will have to have more at 9:30. So yeah, this is a summary. So CAGR is basically an average of the growth percentage. If you know individually, you can do, or on an average also you can compute. The formula is this. So last year divided by the first year raised to the power 1 divided by number of years, totally is subtracted by 1.
Makes sense.
So I think I have come to the fag end of what I wanted to explain. So yeah, I think we have also run out of time. I will share all of these, and if you have any questions, yeah, please reach out to me. I can help you.
Thank you. Thank you
Thank
so much.
Akash.
This was
Thank you for the session.
beautiful.
For any further session, we will get in touch with Jeet, all our class. So he's our CR. So he will coordinate. So instead of a lot of us reaching out to you,
yeah.
Jeet will be ideal for us.
Sure. Yeah, okay. I will pass on all of this that I made now to
Yeah. That will be great.
Thank you. Thank you, Akash.
So much once again.
Thank
It
you
was
so
really
much.
helpful.
Thank you.
Thanks. Bye.
Thank you.